So for original discount, the first question is, am I going to get cash at least once a year? If the answer is yes, then I just include income when my anniversary date comes. If the answer is no, then I'm going to be forced to an accrual rule. And remember that OID is the net present value concepts. And here the interest is eventually going to be paid. All right. So every year, if you were doing formal books, you would debit interest receivable, you would credit interest income, and then at the end of 5 years, when you get all that cash, you would only pay taxes on the interest for the 5th year, because everything else would be return of basis because you'd already paid taxes on the money. So the accrued interest, like I said, is added to basis, so you don't pay taxes on it twice. All right, so now we want to look at imputed interest a little more deeply. As a general rule, imputed interest implies that we're charging a 0 rate of interest, but we might just be charging a rate of interest that's too low. So how do we know if the interest rate is high enough to keep the government happy? Well, every 6 months, the government publishes applicable federal tax rates. They will tell you what they believe the floor on interest should be, and they will tie it to demand notes and 1-year notes, 10-year notes. So there'll be rates for different types of length of loans. In our notes, we will refer to this as the AFTR. Right? So if you're going to make a loan and you want to make sure you've dotted all your I's and T's, you want to look up this document and make sure that the interest you're charging is at least at the minimum rates. And if they are, and cash is paid at least once a year, you follow the include when paid rule. If not, you have to impute interest using the applicable federal tax rate. So if it's a demand loan, you'll use one rate. If it's a 10-year loan, you'll use another rate to impute interest. So we're going to include interest income, even though we are never going to get the money. All right? The reason for this is there is an advantage for rich people to be able to lend money to related parties at a 0 or low interest rate, because first, they don't need the money, right? And if I'm in a 35% tax rate, if I collect $1 worth of interest income, I have to give the government 35 cents. And if that money's coming from my kid and I'm supporting my kid, I have to lend him the $1 so he can give me the $1 back. And then I have to give the government 35 cents. And you see that math doesn't make any sense at all, right? So rich people will have a tax advantage because they don't need the cash flow. And so they give a formal loan to a related party. But you get a note, right? Because you want to get the money back, right? And we know that our kids, God love them, who knows what they might do 5, 10 years from now. So I'm not going to make an outright gift of the loan, of the money. Instead, I'm going to have a piece of paper that says I have a legal right to get the money back. But I don't want to compound the issue by getting interest back, so I'm going to make an interest-free loan. I can do that legally, but the government now has the right to tax me on the interest income that I walked away from. Remember, substance over form. The substance was that there is some sort of special deal here, otherwise I would have charged interest. And this is an issue that drug on for like 10, 15 years, where the government tried to attack various gift loans, zero interest loans. And the courts kept coming back and saying, we understand the issue, but there is nothing in the tax code that says you have to impute interest. So they wrote a tax code, a 7872, which goes on for about 15 pages, which is really complicated legislation, which then forces people who are charging interest rates less than the applicable federal tax rate to impute and pay taxes on money they're never going to get. So how does imputed interest differ from original issue discount? Well, remember, there's a pretend payment of the interest. You're always income to the lender, but you're never going to get the money. Under the original issue discount, you created an asset called you owe me interest income, and eventually you got the cash. That's not going to happen here. So the government does not want you calculating a bad debt expense or other item because you've had this income and you're never going to get the money. So we need a second transaction to make the accrued interest go away. And so that's the part that gets more complicated here. Because remember, you simply take the amount of the loan, you look up the applicable federal tax rate, you do basic math. That tells you how much income the lender has to include. But now we have to make that money go away. So the pretend repayment back, its tax character will be a function of the relationship between the parties. And that's what we're going to look at in the next set of slides. So as you follow these examples, this should become a little more clear. All right, so let's first of all review the first transaction. The lender is making an interest-free loan for 5 years. The borrower makes no payments till the end of 5 years, and they're only expected to give back the original principal. All right, so at the end of the first tax year, the lender has income as if interest was actually paid. The borrower does not owe more to the lender, so we got to do something here. At the end of 5 years, the lender gets paid back just the amount of the loan. All right, he's not going to get any accrued interest, and so we want to make sure he doesn't have an account called John owes me $5,000 worth of interest income, so that he can't then say, oh, I get to take a bad debt expense because I'm never going to get that money. So the second transaction, the lender has to give the imputed interest back. I'm going to put that in quotes because we never got it to begin with, so what we're giving back is another fake check. So you can think of it, as you will, as the borrower gives the lender a check, the lender tears it up, and then the lender gives back another check on its own account to the borrower, and the borrower then tears it up. So the lender and borrower, the tax treatment depends upon the relationship between the parties. So if they're related, it's your son, your daughter, your mom. Frequently, these are referred to as a gift loan, right? Because I am loaning you the money, and I'm giving you a free ride on the interest. Right? So now what happens to the pretend repayment back? It's treated as a gift to the borrower. And back in Chapter 5 somewhere, it's going to say that the borrower pays no taxes on a gift. The lender may have to pay gift taxes. We'll discuss gift taxes towards the end of the semester. But remember, not taxable to the borrower. So if you are a rich person, you might get hit twice. You might get hit for interest income, and then you might get hit for gift taxes without ever having gotten any cash or made a real gift. All right, so the second transaction itself remains the same. We're going to give the imputed interest back. This time the lender is the employer. We call these compensation-related loans. Your boss wants you to move to Boston to take over management of the operations there. You go up for a trip and you figure out that if you sell your $200,000 house, you'll be able to buy 12 square feet in Boston. And you come back and say, hey, I can't do this. There's no way my family can have any type of reasonable living on what I can afford to buy a house. And so the employer wants you. You're a really good employee on your way up the food chain. So it's very common in this kind of situation for them to say, well, we are going to lend you enough money so that you can land up with exactly the same house in Boston that you have here. But we are, of course, going to file a lien against the house. If you leave us, you leave our employment, that lien will immediately become due and you'll have to pay us back. If you sell the house, you'll have to pay us back before you can keep any of the cash. Kind of those golden handcuffs. So now that you're in Boston, you can't afford to leave because you can't afford to sell the house. Now, why does the employee like that? Well, the employee, as we'll see, is going to have to pay some income. But instead of giving the bank $1,000 and getting a tax deduction for mortgage that we'll discuss in Chapter 8, instead the income goes up by $1,000 and he'll pay taxes at whatever his marginal tax rate is. So he owns the house, he's building the equity in the house, and instead of giving the mortgage company $1,000, he's giving the federal government $300. So not a bad deal, considering that the move to Boston came with prestige and promotion and hope for upward mobility. So now the pretend repayment back, that is the money that the employee is giving back. I didn't say that right, did I? It's the money that the employer is giving back to the employee. Well, the primary qualification for what comes from an employer to employee is simply salary. And so it's classified as ordinary income taxed at the employee's highest marginal tax rate. The employer gets a deduction because the employer has paid more salary. So the employer has interest income, but essentially gets to offset it with salary expense. So the employer will come out to a net zero on this transaction, and there shouldn't be any tax consequences at all, just the paperwork. Same transaction. This time, it's a corporation lending money to the shareholder. And it doesn't matter whether it's a regular or a C corporation. It's the corporation lending to the shareholder. Now, when the corporation gives the fake interest check back to the shareholder, what is the most general classification of what corporations give to shareholders? And hopefully you will say that's a dividend, right? And when a shareholder gets money from the corporation, it's generally classified as a dividend. And so the shareholder will have dividend income. It may get the special tax rates if it's a qualified dividend. What does the corporation get? Not much, right? Because paying a dividend, since accounting 203, you know that dividends do not a deduction make against the income of a corporation. And that's the same rule for both tax and for financial. So it's simply a contribution to capital, right? The second transaction, again, this time the shareholders lending money to the corporation. And we talked a little bit about that in the first set of PowerPoints. Sometimes shareholders want mixed equity. All right, they want to be able to collect interest income because interest is deductible to the corporation. Dividend income is not. And so sometimes corporations will be funded 60% debt, 60% stock, 40% debt. You really probably couldn't do it the other way. And you'll talk in your corporate class if you're going there about what the debt to equity ratio can be without causing the IRS to get messy. So now the pretend repayment back is simply a contribution to capital, which is normally when shareholders give money to corporations. What is it? It's a contribution to capital. So no income or deduction to either party, and the shareholder does get a basis increase, right? Because they paid taxes on the fake interest. So when they give the fake interest back, it increases their basis in the corporate stock. Imputed interest has a couple more rules that we're not going to formally discuss. Related party loans just get really messy, and there are some exceptions. There's a $10,000 exception and a $100,000 exception, depending on who you're lending money to. Once again, I would suggest that you read that material in the book so that you don't come to class and cold turkey late at night on a Thursday have to read all that gobbledygook to figure out whether or not the loan met an exception. Now, final reminder, I won't ask you to do the math. I will not ask you to calculate the dollar amount of the OID or imputed interest, but I do expect you to be able to articulate what the tax treatments are in each of the scenarios that we've just covered. Dividends are pretty straightforward. E&P, earnings and profit. Earnings and profit is not taxable income. It's not retained earnings. It's not a pure GAAP concept. I will leave it to the corporate class to define that for you. Most of us just don't need to know because we get a 1099 from the corporation and it tells us whether or not the dividend is ordinary income because there has been earnings and profits. Most are now treated like long-term capital gains. We discussed this, did the tax calculation in the first set of PowerPoints. And our default will be, if I say there's a dividend, we will assume that it is an ordinary dividend and it's also a qualified dividend. So if I only tell you that John collected $1,000 of dividend income, I will tell you the word qualified, and that will tell you to use the tax rates that are here. Right? If there is no earnings and profits, I will specify that a corporation that had no earnings and profits made a dividend distribution. And in this case, first of all, you get back the money you have tied up in the stock. That's called return of capital. We'll talk about that at length when we go to the last part of the class. So if my basis in the stock is $100, the first $100 that I get back has a zero tax rate because it is simply getting my money back. Anything over that will be capital gains because in a sense then if there's no earnings and profits, it's deemed to be that I've sold the stock back to the corporation. At least that's the tax treatment. Remember, nowadays it probably wouldn't make any difference because in all likelihood it would be a qualified dividend entitled to the rates above, and those are exactly the same rates that long-term capital gains get taxed at. But there are some nuances here that we'll talk about at the end. And then if you own interest in shares in a mutual fund, mutual funds are allowed to pass out their long-term capital gains as a form of dividend. Once again, the 1099 you get from the corporation's got lots and lots of boxes. We'll see one of them, I believe, tax return 5, where if you've never seen one, you can see what the form looks like. Note that we will have a mutual fund paying out a dividend, a capital gains distribution towards the end, one of our last tax returns, and I will simply prompt you at that point to treat it as a capital gain rather than treating it as an ordinary dividend, and you'll simply deal with the tax treatment at that point. And then sometimes you get stock dividends. I'm sure in your corporate classes, even as early as Accounting 203, we've talked about them. All right, that's when you don't get back money, you get back stock. For tax purposes, they're generally not taxable. All right, because what are you doing? You're ripping up the share, and so now instead of having one piece of paper, you have two pieces of paper. Of course, there's always an unless, right? If you have a choice between getting money or stock, those are referred to as dividend reinvestment plans. You have ordinary income, and even though you haven't gotten cash, you've just gotten more stock, you will have to pay a dividend, a tax as if you had taken the cash and then bought the stock. Remember, substance over form, because that's really what's happening in a dividend reinvestment plan. They're giving you your dividend, and then you're giving it back to buy more stock. And then if you have common stock that gets you back preferred stock giving you back a common stock dividend, that will also trigger a tax. All right, just a couple more slides, stuff you already know, because hopefully in addition to listening to these PowerPoints, you're working your way on tax returns 1 through 4. And you know that the conduits are partnerships, S corporations, trusts, and estates. And you know a little bit about each one from the first set of PowerPoints. And you know we're doing absolutely nothing with trust or estates, right? We just don't have any time. So we report the income on Schedule E, page 2. And if you haven't started tax returns 3 and 4, you'll see what that form looks like when you do. And it doesn't matter when you get the cash. What matters is the amount of income the entity has earned during the year, because it will complete a tax return. It will parcel out all of the income it earned during that period, retaining the character of everything, and you get to pay taxes. All right. So why do I have a sole proprietor here? Sometimes sole proprietors are limited liability companies themselves. And so some people would think of them as a flow through, others wouldn't. Partners, that's tax return 3. That's limited liability companies now, rather than partnerships, if you remember from the first set of PowerPoints. And then S corporations. And they simply report their percentage of the income as earned, retaining the character. So ordinary income is still ordinary. Qualified dividends are labeled as qualified dividends. So the tax treatments are identical whether the money was earned through the partnership or was earned by the individual directly. Trusts and estates use a slightly different rule. They report only income as distributed if you are a beneficiary of a trust or an estate. A trust and estates have their own tax rate schedules, and so this rules once again can get really complicated. A simple trust, by definition, distributes out all of the income, so it's going to look a lot like a partnership, even if the income hasn't come out by the end of the year. Complex trusts and estates If they keep the income, they pay taxes on it. If they distribute it out, the beneficiary pays taxes. This is a topic that we're simply not going to have any time to cover. I believe you might get a 30-minute lecture at the very end of your corporate class. It is not an area that's heavily tested on the CPA exam, but there will be an opportunity for you to review these issues as you are preparing to take the exam. So I wouldn't worry about it at the moment, right? You got enough to think about. Well, that includes part 1 of chapters 4 and 5. Now your job is to go back in and do the PowerPoint quiz. You have these lectures to go back and refer to. You certainly don't need to memorize anything, but your job is to understand as much as possible. Not this week, but next week when you come to class, the mini test will be a function of what's here. So you're going to get some sort of Social Security calculation. You're going to get some sort of information about imputed interest, OID. And so you'll want to make sure that you have focused on those things before you come back in the following week. The mini test for class 2 will focus on the information that was on the first set of PowerPoints. It'll be heavily focused on doing income tax calculations, employment tax calculations, and self-employment tax calculations, because I want to make sure everybody knows how to do those. So review the PowerPoints, review the tax calculations that you did for tax returns 1 and 2. They're both due at the beginning of class, and they take you through income tax calculations, employment tax calculations, and self-employment calculations. And then there might be a couple of trivial questions on other material that was discussed in those set of PowerPoints. You will have the ability to look back through the PowerPoints. You can have your book. Just remember that time is limited, so you won't have time to learn everything while you're doing the mini test. And it is going to be after 8:30 on a Thursday, and your brain is not going to want to have to do anything demanding. And so the more you prepare, the better off you will be. I'll see you soon.